Hello, everyone. Today on the Final Bar, my guest is Craig Johnson from Piper Sandler in Minneapolis. We're going to talk about the big picture. S&P really distributing through the course of the afternoon, gapping lower in the morning, rallying back up, but signs of distribution sort of formulating along the way with fairly defensive side of the markets at the top, led by consumer staples and utilities. We're going to dig a little bit into the sentiment readings, a big spike higher in bullish sentiment for the first time in a while. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the message that the markets themselves provide. We focus on price action and also indicators of sentiment and breadth and other tools in the toolkit, all as a way to understand the collective psychology of investors. And what's interesting when you look at what happened today relative to previous days, what sort of signal did we get? Well, overall, at this point over the last couple of days, you're starting to see the signs of what I would characterize as an exhaustion of buyers. Right? We've stopped going higher over the last month. If you look at the trajectory in the S&P, we sort of hit an all-time high there, about 4,200. We've been unable really to reclaim that with any significant upside. And so at this point, the open question is, do we have enough momentum to push ourselves to new highs? And what we've seen so far, not the case. Days like today, which are more defensively, more risk on versus risk off with tech and consumer at the bottom of the list, makes me skeptical about further upside. And look at stocks like Tesla breaking down out of key support levels. We're going to get to all of that and more here in a little bit. Guests coming up on the show. We have a great guest today, Craig Johnson, who's been on the show a number of times, always brings some great expertise along with him. Next week on Tuesday, the 8th, we have Jesse Felder from the Felder Report. On Wednesday, June 9th, Javed Mirza from Canaccord Genuity up in Toronto. On June 10th, next Thursday, we have Sam Burns from Mill Street Research in Boston. Also, as a reminder, we just wrapped over the last week our Chart School series. We focused on idea generation. We had 5 different experts all providing their, the way that they use the scanning engine on StockCharts to find ideas. If you missed it, no problem. You go to stockcharts.com/chartschooltv. You'll also find all of the content on our YouTube channel and on StockCharts TV on demand. Let's continue on with our market recap today. So as I mentioned, the S&P really gapped lower right out of the open. It sort of moved higher in the late morning, but then from there, it was really a continued pattern of distribution. You can kind of see this pattern of distribution over the last 2 days where you're sort of, dribbling lower through the course of the day and finishing a little bit weaker. The S&P today down just over 1/3%, but back below 4,200. The NASDAQ actually led the way a little bit further down, just over 1%. Mid caps and small caps all underperforming the mega cap trade today. The VIX, by the way, back above 18 today. Looking at other asset classes very quickly, bond prices down with the 10-year yield back around 162, 163. The dollar actually had a pretty decent day, coming out of a pretty long-term downtrend, a fairly consistent downtrend, bouncing higher about 2/3%. Commodities overall actually coming off. We talked about the long-term strength in commodities. And while I think that thesis is still a fairly strong one, you certainly had gold and silver coming off today, with gold down about 2%, which was one of the worst days you've seen in gold in quite a while. Cryptocurrencies back to the upside. So if you think of cryptos as sort of a risk on measure, you sort of got it. It's difficult for me, looking at days like this and looking at other days. I don't think it's a consistent measure of risk on or risk off. It's certainly a sign of speculation, and you're certainly seeing a healthy amount of it with Bitcoin getting back above 38,500 around the close in New York. But overall, nice green positive days in crypto land. Let's look at the chart of the S&P 500 and just look at what's happened. So when I talk about an exhaustion of buyers, early in my career, I spent time with people like Tom DeMark, who talked about, a trend doesn't end because of an influx of sellers. It's an exhaustion of buyers, right? The last buyer anecdotally has placed their trades and no one is left to push the price higher. So in an extended uptrend, which arguably we certainly have been in with equities. The question is, when are buyers exhausted? When do you see signs that that there are no more buyers left, right? That investors are all in and there's just no more demand or no more additional demand to push things higher. There are a series of things we can use to try to measure that. We can look at breadth data and see if you're seeing distribution in certain parts of the market, which might not be reflected on the S&P chart. You could look at sentiment data and see if investors are getting less bullish, or people are starting to, if they are euphorically bullish, sort of everyone's bullish, right? The AAII survey above 60, 70% would certainly be in my opinion, sort of a screaming self signal telling you, wow, if everyone's bullish, then no one's left to push the price higher. But, arguably the most important thing you can look at is price. And again, I go back to conversations with Ralph Acampora, one of my mentors, who always said, if you want to understand, the S&P 500, you want to understand the market, don't look any further than just the price of the S&P 500. Look at the chart of the index. That will tell you most of what you need to know in terms of supply and demand and fear and greed. And when I'm looking at a chart of the S&P and I'm looking at the peak from late April and I'm looking at the peak from early May and I'm looking now at the peak from earlier this week, they're right almost exactly at the same level of roundabouts, just below 4,250, between 4,200 and 4,250. We've now had 3 times where we tried to get past that level and are unable to do so. And so that is clearly a line of resistance. That's clearly a level at which buyers seem to be exhausted. And for whatever reason, the price tends to come back down. Now, what's interesting on chart of the S&P, anytime you have a narrowing range like this, where you sort of you have a support level using trend lines and moving averages that are coming up, you have a fairly resistance level. What's great about this is the pattern will naturally conclude here not too far from now, which means at some point the price will have to resolve out of this pattern one way or the other. We'll have to either break above 4230 to 4250, get above the highs in early May and indicate sort of an all clear sign of prices going higher. Option B, we break below the 50-day moving average. We break below trend line support. I would argue we need to really get below 40.50, which would make a new swing low below the lows in early May. So one of those 2 things is going to happen at some point in the future. And I think seeing which way the prices move from there, I would assume, and I think it's a fair assumption, that whichever way we break out of that range, I think the next big leg, the direction of momentum, the path of least resistance will be in the direction of that breakout. And that's a pretty standard technique. Early in my career using Bollinger Bands, you look at a narrowing of the bands, a narrowing of volatility, and see which way it broke. And I think that's kind of the environment we're seeing here. We don't have time to get into too many individual stocks, but Tesla was certainly getting a lot of attention today, breaking back below its 200-day moving average. This is a second day of fairly decent decline, sort of mid-single digits, down another 5% today, but it's getting back down to that 550 range, which was the low from March, really was the low from early December. There's sort of a little swing low there a couple times before the big move into the January peak. From there, it's bounced off of this 550 level a number of times. Now, back below the 200-day moving average, my question is, does it fail to hold support there? And if so, from a technical perspective, I think you have a lot of potential downside. For me, it would be down to 400, which would be that next major step lower. That's the next real support after around 550, is getting back down to those lows from the fourth quarter of last year, which is a pretty decent decline from where we're at right now. I mean, that's a 25-ish%. I'm doing math in my head, but that's about what that would feel like. That's a pretty significant move lower from where we're at. My question is, what's the overall environment if a stock like Tesla is breaking support and pushing that direction? Other charts we've looked at recently, and then we'll finish our wrap. The ARK Innovation Fund, which obviously when you're looking at Tesla, this is the chart that's sort of in the back of my mind here. I recorded a video on my YouTube channel a couple of weeks ago, maybe a week or 2 ago. My channel is called Market Misbehavior, and we talked about this chart in particular and just the signs of distribution. And thinking of this using Fibonacci retracements, you had a bounce off of the 38.2% retracement level in March. We had a bounce off of the 50% retracement level here in May. We've now bounced back up to the 38.2% retracement level and just starting to roll over. By the way, this resistance that it's facing was also the 200-day moving average and also a trend line taking the highs from February and April. So it seems like a very clean, orderly chart. and an expectation that we start moving lower. You bounce off of the 50% line. That would be the next clear support level here, right around $100, which often a big round number like that serves as clear support. And then I think if that doesn't hold, which I'm afraid it won't, then you have to start looking to the next support level, which is just above 81, which also lines up with the September 2020 low. So the challenge with a lot of these names is we are sort of right at that point where you could start to make the argument that we're unable to hold support, and that does not bode well for next step. Apple is the last one we'll look at here, getting back below its 200-day moving average as well. That's after breaking down out of a symmetrical triangle pattern here. I think this is arguably it's made the signal, I think, but this is a fairly negative chart in my opinion. This doesn't tell me to be expecting great things from technology. This tells me to be leaning more defensive or into things like infrastructure plays and others that are holding up much, much better than some of these tech names that are struggling. Just to wrap up our market recap very quickly here, it was really defensive stocks leading the way, consumer staples and utilities, leadership spaces we have not been thinking of very often, doing just fine. On the downside, it's the trifecta of offense: consumer discretionary, technology, communication services, the FANG trade struggling today. We need to take a quick commercial break. Back with my guest, Craig Johnson. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the market activity using the power of charts. As a reminder, we'll do another mailbag segment on Friday's show. We would love to hear from you and answer one of your questions on the air. Anything about market dynamics, market history, market psychology, charts, breadth, sentiment, whatever it is, we would love to help you out. Our email is thefinalbar@stockcharts.com. We're on Twitter at finalbarsctv. Finally, on our YouTube channel, just put a comment below the video that you're watching. We'd love to hear from you and answer one of your questions on Friday's show. Also, as a reminder, go to stockchartstv.com. Use your email, set up a free account. You can watch all of our great content on our website and also on all the app stores. Just search for StockCharts TV on demand. I want to welcome on my guest joining us once again on the show, Craig Johnson. Craig is the technical analyst at Piper Sandler in Minneapolis. Craig is one of the relatively few in the financial industry that hold both the CMT designation and the CFA designation, which is code for he really knows his stuff and has a lot to share. And Craig, welcome back to the show.
Dave, thank you very much for having me back. Appreciate it.
It's always good to sort of get your take on things. And, right now we're looking at an S&P. I mentioned earlier in the show, I sort of described it as, an open question. Have we seen an exhaustion of buyers? Because we keep hitting this same resistance level and starting to pull back a little bit. What's your take overall, big picture on the S&P?
Well, Dave, I'd start out about that scenario and put it into a quote from your mentor, my mentor, Ralph Acapora. And that is, there is knowledge in price, and then there is truth in volume. So if you look around at all the volume numbers that you've been seeing today, and you put this into the price perspective, Dave, I guess I would just come back and point out to everybody that, yeah, this market is struggling in here at this point in time, but I'll be looking at the volume, seeing if that's really sort of confirming what we've been ultimately seeing. And when I go through and I look at some of the stats on volume hasn't been huge at this point in time. So I think this market is just sort of marking time. And really, after having a huge sell-off last year and a big recovery, the market's playbook historically has been you start digesting those gains and you start watching the market grow up into that sort of valuation. And just as an example, earnings over the last 90 days for the broader market, S&P, has grown up almost 9%. And you've seen the valuation argument come in 1.5 turns. So the market is doing just that. It is truly just digesting. And Dave, I agree with you. This market is coming into a period of time where we're either going to have to break out topside, or we're going to have to ultimately break below that uptrend support line that you have drawn right there on your chart. I think your third scenario, though, might actually be that we come back down, retest the lows we had seen back in May, and we just end up consolidating sideways, probably from now until Labor Day. And the market just continues to rebuild strength and continues to just consolidate sideways. But Dave, it's been a very difficult market. Talked to a lot of accounts over the last several weeks since our last monthly publication has come out. And it's very clear that people are mispositioned in this market. And what I mean by that is they can see the market having moved higher, now consolidating. But if they're trying to get that absolute and relative outperformance, they got to also get their sectors selection correct. And right now, the best performing sectors in the market are more of the cyclical growth areas of the market. Things like basic materials, things like industrials, things like the energy sector. In fact, Dave, inside of our work, energy and basic materials are among the two strongest sectors inside of all of the group work that we do. And I got to tell you, that represents, about 6-7% of the overall market cap weight of the entire market. And most institutional investors have not in any serious way pivoted toward those areas yet. So that's why this market is so challenging, and why tech has been for sale, and why healthcare has been for sale, because a lot of the growth sectors are becoming the source of funds as you're starting to see some of the institutions rotate towards some of that kind of early cyclical type growth areas of the market.
It's so many interesting points in there, Craig. And I remember you may or may not remember this, but in the chart room at Fidelity, we used to have a whiteboard, and we would have 3 arrows: an arrow going up that said up, an arrow going down that said down, and an arrow going sideways that said frustrating. And I think you may be right. That third direction of just no real bullish or bearish bias a lot of times is frustrating, because then you really have to look for opportunities at the sector level, at the thematic level, or something. You had mentioned, sort of this, this difference between tech, consumer, and we're looking at all 11 sectors here. And technology has put in, so far, sort of a lower high, consumer discretionary putting in a lower high. But you look at something like energy, and it's actually rotating and making a new high again this week. If you're looking at the market now based on what you're seeing, is that where you should be allocating into things like energy, industrial, sort of the infrastructure, cyclical types of plays? Or do you find opportunities to buy on the weakness in some of those former leadership sectors like technology?
Well, Dave, I think everybody's got to add some some energy exposure. And where we've positioned based upon the work that we're doing is we're recommending the institutional accounts be overweight basic materials, okay, which is like a lot of people are like, what? Basic materials? We've also recommended that they remain overweight financials, and also remain overweight the consumer cyclical sector. So what we've been trying to do, and what we're seeing in the market right now, and why this market is just sort of churning, is because, again, those are more value-oriented sectors than growth sectors. And also people are sort of having to trim their technology names, which are the biggest exposure in the market right now. 20+% of the entire market cap is technology, and they need to rotate into these other areas. And that's why this market is just sort of churning. And that process is probably going to take quite some time to work its way through. And to be honest with you, Dave, I would have thought this market would have had a deeper correction by now, when the leadership parts of the market, AKA technology and healthcare, are fading and rolling over. But we haven't seen that. And the lifeblood of any great bull market, again, is going to be rotation, rotation, rotation. And that's exactly what you see happening underneath the surface. And then, Dave, the areas where I've been saying that investors should be underweight at this point in time is going to be the utility sector, consumer staples, and also healthcare. So you can clearly see from what the market is telling us to do right now is to sort of pivot a little bit toward interest-sensitive parts of the market. And that is also leading into some of the early cyclical growth and value components. And people need to sort of start pivoting that way. And again, I think they need to start doing that in the next 30 days in a more earnest way, the next 30 days. Otherwise, they risk underperforming for their funds for the remainder of 2021. They won't have time to really play catch up. So look for more rotation. But those are the areas that I've been trying to get investors to steer into, because I think that's where they can get absolute and relative outperformance.
We'll have to leave it there, Craig. It's awesome as always to hear your insights. Thanks again for bringing some comments with you and helping us think through some of these charts top of mind for all of us. Craig Johnson from Piper Sandler. Be well, stay safe. Talk to you again soon.
Thank you, Dave.
That's Craig Johnson. Craig's the technical analyst at Piper Sandler in Minneapolis. And again, if there's something I miss the most about working at a large buy-side institution, besides some of the great people that I was able to work with, and a lot of people looking at a lot of charts that it was great to compare notes with. It was also a pleasure to have guys like Craig that we could speak to regularly. Really miss some of his insights, and super glad we can bring some of that expertise to you today. Let's continue on with our next segment called Getting Sentimental. So a lot of the sentiment data that we look at every Wednesday or look at every week comes out Wednesday into Thursday. So it's sort of a natural time to check in on some of the sentiment readings that are out there. And to be honest with you, when if you've heard me describe my own process, I sort of think of it in priority level at the big picture level, starting with price and then breadth and then sentiment. My main goal is to understand price. And if I had nothing else, I would look at the price of the asset and analyze it that way. Second to that would be breadth. So I'm very interested in participation and seeing, especially when a market does one thing, but the breadth disagrees with that. I think I've found a lot of times where that ends up being a really good signal of negativity that may not be obvious looking at the price itself. The third piece of that is sentiment. And for me, sentiment usually falls more in the anecdotal category. Things I would find with sentiment often, lead me back to other charts that I might want to look at. As an example of sentiment, by the way, just recently, The Economist had a discussion of Brazil and talking about the struggles there, and had the statue of Jesus that overlooks the city of Rio de Janeiro with a gas mask on, implying the struggles with the coronavirus and sort of reviving the economy. And someone had mentioned that's sort of a contrarian bullish signal, and it made me think of. In 2009, you had the cover of The Economist had that same statue blasting off like a rocket. And it was talking about Brazil basically going up with no pause. And that was probably within a week or two of the peak in 2009 before it spent quite a long time in more of a downtrend. So things like that, magazine covers and other anecdotal evidence for me always gives me or leads me to dig deeper into things like price and breadth to try to qualify it. So let's go quickly through some of the sentiment readings that we follow and just see where they're at today. So the VIX is actually back below 20. Over time, there have been times, especially like 2019, before the sell-off in February, March of 2020, the VIX was really in sort of the 10 to 20 range, and that was sort of it. That all changed in March of 2020, really February, when it exploded to one of the highest readings in history, over 80. Then came to settle back down, and for much of the last year, it's been in sort of the range from 20 to 40. And that's changed now. So starting in March, you sort of have a new range, and we've sort of gotten down to the 16 to 17 at the low end, and then back up to the upper 20s in the higher end. That may be the new range that we're in. It's really hard to tell. And I think one of the challenges with the VIX is it's not necessarily range bound. You have to look back at history and see when the market has topped out or bottomed out, and draw some conclusions that way. For what it's worth, we're back down toward the lowest levels the VIX has been really since the February 2020 peak. And I think that's noteworthy, right? And when we talk about a market that's had a run, we talk about the potential exhaustion of buyers, as Craig was mentioning, a potential sideways environment, which would be probably super frustrating to many. The fact that the VIX is very low, similar to where you were in mid-April and early May when we hit those market peaks, I think it's an interesting data point to pay attention to. Second chart is looking at the AAII survey. This is a weekly survey of individual investors. The last 3 weeks, the bullish rating has essentially been the same, really hasn't moved at all. And it's been about 36, 37, 38-ish% every week. That actually has increased over the last weekly reading today up to just about 44%. The bullish reading, the bearish reading has gone down from 25, 30% down to just below 20%. So you've had a bit of a bullish adjustment to the survey data. There's been a difference of about 10% between the two, and that's back to around 24% as of this week. So an increase in bulls. It's not at the euphoric levels. I tend to look at, above 50% as sort of euphoric, and start to think about the challenges of too many people being bullish and how much more the market could run. I don't see that right now. I see more of a mid-range bull market sort of sentiment rating on the bullish side. So for what it's worth, that's where we're at. The name exposure index has increased. So for the last 2 weeks, you've seen a steady increase in the name exposure index. About a month and a half ago, it was up over 100%, which is in the euphoric range. 2 weeks ago, it was back down to almost 40%. It was around 43%, which was a fairly low level for a bull market phase. Now we're back sort of in the mid-range, back above 80%. So if you look back, this is actually mid-range. So both of those sentiment readings are not at extremes. They're actually at a fairly normal bull market range. What is interesting, and the last data point we'll look at, is the RIDEX flows, which is at 0.08. If you look back in the history of this data series, it is literally at the lowest point that it's ever been. And so what that means anecdotally is that individual investors rotating between RIDEX funds are at the most bullishly positioned they've been, basically in bullish and sector funds versus bearish and money market or cash funds. And again, what that means is, again, anecdotally, that means that individual investors are all in and bullishly positioned. That tends to mean the uptrend is at an exhaustion point. That's all the time we have. The last thing I'll just mention is the put call ratios back down to extreme lows. That actually might be an interesting point to point out. The equity only put call ratio, not quite at the lowest levels we've ever seen, but certainly very quickly in the last couple of weeks have gone from a relatively a higher level for an uptrend to actually one of the lower levels that we've seen. That might be interesting to see in the coming weeks to see if that continues to decline. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the chart of Bitcoin. We didn't talk about cryptocurrencies too much, just to talk about the rise today, while stocks overall were sort of in decline. Most other risk assets were coming off a little bit. It's a fascinating chart to watch only because it was, in a steady increase. You had a steady pattern of higher highs and higher lows that all changed in April. When you had a lower low, you had a lower high, and then you resolved lower. From there, we follow the Fibonacci retracements pretty well, and we bounced off of support just below the 61.8% retracement. That's using 10,000 as the low. That was a very significant level back here in late 2020. That's taking the all-time high there in mid-April, and from there we've declined 61.8% of that range. Now we're sort of range bound between these two, and I have these blue shaded areas and pink shaded areas sort of indicating confluence of resistance and support. We're right in the middle of the range. So the question is, just like with stocks, do we resolve the pattern to the upside? Do we get above the 200-day moving average and get above that last Fibonacci level there? Or do we break below really 3,000, which would take it below some of the support levels that we've seen recently and over the last really year to date on that chart? After talking with Craig Johnson, though, I'm thinking maybe option 3 is we're just range bound, and frustratingly, Bitcoin goes nowhere but sideways with these big price swings. That certainly could be a scenario. Chart number 2 is looking at AMC. I was asked a lot about this in media outlets in the last 48 hours, really 24 hours after the big explosion higher in AMC. And, the question is, how do you trade something like this? To be honest with you, I tend to avoid something like this because I think the value of technical analysis is there is a fundamental value for a stock like this and any other stock out there. And I think technical analysis is about navigating where we're at right now to where the price should be based on a fundamental valuation. The CMT Association does a great job of articulating that in much greater detail. So at this point, I think you look at short-term charts, look at hourly and 5-minute charts. If you would pick a line in the sand, for me, it would be the low from yesterday. I think with GameStop and others, you have recent swing lows. It would be really important to pay attention to. The challenge with the stock like this is just when it can rise exponentially, it can also fall exponentially. The last big run you had on these sort of charts, you gave back 50 to 70% of it very quickly soon after as that bubble unwound. So buyer beware there. Finally, the AAII survey, bulls sort of back in the driver's seat, still not at euphoric levels, but I think that's an interesting chart to watch going forward to see if we get back to levels of that I would describe as euphoric. That's our show for today, folks. Thank you so much for joining us. Special thank you to Craig Johnson from Piper Sandler, joining us from Minneapolis. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.